Realization basis for calculating taxable income, an election for taxable persons. For businesses that prepare their financial statements using the accrual basis of accounting, the calculation of taxable income can be complex, particularly when it comes to recognizing gains and losses. A key aspect of this is the treatment of unrealized gains and losses on assets and liabilities, especially those measured at fair value or subject to impairment under accounting standards such as International Financial Reporting Standards, IFRS, or IFRS for small and medium-sized entities, IFRS for SMEs. To simplify the taxation process and align it more closely with actual cash flows, businesses may elect to account for gains and losses on a realization basis. This article explores the option to elect the realization basis, the impact of this decision, and practical examples illustrating how it works. 1. Overview of the realization basis. Under the accrual basis of accounting, a business recognizes revenues and expenses when they are earned or incurred, regardless of when cash transactions occur. This approach means that unrealized gains, increases in asset values, and unrealized losses, decreases in asset values, are included in the financial statements, even if no actual transactions have taken place, such as a sale or transfer. However, for corporate tax purposes, businesses may choose to exclude these unrealized changes when calculating taxable income by electing to apply the realization basis. The realization basis means that a taxable person only includes in their taxable income the gains or losses that are realized, or realized, through an actual event such as the sale, transfer, settlement, or write-off of an asset or liability. This ensures that businesses are not taxed on increases or decreases in the value of assets and liabilities that have not yet resulted in actual cash flows. 2. Making the election. Requirements and implications. A taxable person can make the election to apply the realization basis for taxable income calculation, but there are specific guidelines and implications for making this choice. Types of assets and liabilities affected. The election can be made in relation to all assets and liabilities that are subject to fair value or impairment accounting under IFRS or IFRS for SMEs. Alternatively, the election may apply only to those assets and liabilities that are classified as capital assets under the same accounting standards. The decision to elect this basis can help reduce tax obligations by excluding unrealized gains and losses that do not reflect actual cash transactions. Once the election is made, taxable persons must exclude any unrealized gains and losses from their taxable income calculation if the value of a non-financial asset changes. Similarly, any changes in the value of financial assets or liabilities will also be excluded unless the gain or loss is realized through the disposal or settlement of those assets or liabilities. What constitutes realization? The process of realization includes events such as selling or disposing of the asset or liability, transferring the asset or liability, settling the liability, writing off the asset or liability in accordance with the relevant accounting standards. These events trigger the recognition of gains or losses for tax purposes, ensuring that businesses are only taxed on the actual proceeds or settlements they receive, rather than on changes in value that have not yet resulted in any tangible financial outcomes. Timing of the election. The decision to apply the realization basis must be made during the first tax period of the business. This election is then considered irrevocable, meaning that once the decision is made, it cannot generally be reversed. However, in exceptional circumstances, a taxable person may apply to the Federal Tax Authority, FTA, for approval to change their election. If the taxable person does not make the election in their first tax period, it is automatically assumed that they have elected not to apply the realization basis. In other words, the default position is to include unrealized gains and losses in taxable income unless the realization basis is explicitly chosen. 3 practical examples. To illustrate the practical application of the realization basis, consider the following examples. Example 7. Fair value gain on land. C LLC, a UAE resident company, owns land that is subject to fair value accounting. During the financial year ending 31st December 2025, the company recognized a revaluation gain in its financial statements of AED 10 million. The original cost of the land was AED 50 million, and following the revaluation, the net book value of the land increased to AED 60 million. However, the land was not sold by the end of the tax period, meaning the gain remains unrealized. Without the realization election. If C LLC has not made the election to apply the realization basis, the company would be required to include the unrealized gain of AED 10 million in its taxable income for the tax period ending on 31st December 2025, despite not having received any cash from the revaluation. With the realization election. If C LLC elects to apply the realization basis for all assets subject to fair value accounting, it will exclude the AED 10 million revaluation gain from the calculation of its taxable income for the period. Since the land was not sold, the gain remains unrealized, and therefore, it will not be included in taxable income for that year. Example 8. Loss below original cost. S LLC, a UAE resident company, owns an asset that is also subject to fair value accounting. During the financial year ending 31st December 2025, the company recognized a revaluation loss of AED 50,000 in its financial statements. The original cost of the asset was AED 250,000, and following the revaluation, the net book value of the asset decreased to AED 200,000. Like the previous example, the asset was not sold by the end of the tax period, so the revaluation loss is also unrealized. Without the realization election. If S LLC has not made the election to apply the realization basis, the company would be required to include the unrealized loss of AED 50,000 in its taxable income, even though the loss has not been realized through an actual sale or disposal of the asset. With the realization election. If S LLC elects the realization basis, the unrealized loss would be excluded from the taxable income calculation for the tax period. The loss will only be accounted for if the asset is sold or otherwise disposed of, at which point it becomes a realized loss.